Okay, so now that we know what to do to record our purchases, now we're going to switch over, and now that I've purchased all this material, this merchandise inventory, I'm going to turn around and sell it to my customers. So to record these transactions, first of all, there's always two parts. And again, I like to think about what's coming in and what's going out. So if I make a sale, I've got cash coming in, and I've got the merchandise going out. So there's two things happening, and I need two transactions. So there's always two journal entries for these. So let's say I made a cash sale. So again, what's coming in? Cash. So that's the debit, and the cash is coming in for my revenue. So that is sales revenue. So let's say I sold it to my customer for $1,000. Or, yeah, so let's just say I sold it for $1,000. So I record this first transaction for, this is what I charged my customer. And then the other thing that happened, and so this is a separate journal entry, is that the merchandise went out. So I need to bring the balance in merchandise inventory down, because the stuff is gone, so I need to credit that account. And the debit goes to cost of goods sold. And so I debit cost of goods sold, which is an expense. I credit merchandise inventory, so the expense goes up, the asset merchandise inventory goes down. But this will be for a different amount. So let's say this is what I paid for it. So in each transaction, the debits and the credits have to match, but the sales revenue won't match the cost of goods sold because the difference is the markup or the gross profit. So unless I sold it for exactly what I paid for it and I've got no profit at all, these will be for two different amounts. Let's say I made a sale on account, which is going to be your more normal one. This is really what we're going to see. I'm sorry, on account. So instead of cash, I will debit accounts receivable. Let me write that out. And I will credit sales revenue. Again, this is what I sold it to the customer for, so let's say that's $1,000. And then I do the second half of the transaction, which is a debit to cost of goods sold and a credit to merchandise inventory. So this is a second journal entry, and this again is what it cost me, and the difference between the two is the markup. So it's not super complicated, but again, we just remember when we're selling it, we always have two journal entries to record the sale, one for the sale and one to record the inventory going out. Now, just like in the purchases, we have to worry about discounts, except this time I'm the seller. So I am the one getting paid, and I am the one that's offering the discount or offering that incentive to pay early. So that means if somebody, like, let's say, let's just kind of refer back to this transaction right here. So here's the sale, right? And so now they're going to pay me. So if they're paying me, they're paying this accounts receivable. If they didn't take the discount, I'm getting paid and they're not taking the discount. So I'm just going to debit cash because I'm getting paid cash, and they would pay me the whole amount, and I would credit accounts receivable to show that they don't owe me money anymore because they paid for it. But let's say I got paid and my customer took advantage of the discount that I offered. And let's say I offered a 2% discount. Let's say it was that 210 net 30 or something like that. Those are the terms that I offered them. So I'm still going to debit cash because I'm going to get paid, and I'm still going to credit accounts receivable. Now, the accounts receivable, again, I need to credit that for the full amount that's in here, which is $1,000, but I'm not going to get that much cash, right? So if they owe me $1,000 and they're going to take a 2% discount, so 2% would be the $20, that means the amount that they're going to pay me is $980. So the cash I'm going to get, I'll debit that $980, but I need to credit accounts receivable for the whole $1,000 because they don't owe me any money, so I can't leave a balance in there. The difference of $20 goes to an account called sales discounts. I don't know why those black lines keep coming up, but the accounts receivable will have a zero balance now, showing they paid it. I'll record the cash I got, and in the purchase side, I just lumped that into merchandise inventory. But now I'm going to track that separately in an account called sales discounts. Okay. All right, sales returns and allowances, just like in the purchasing where the return is kind of the opposite of the purchase, it again is, this will be kind of the opposite of the sale, almost. It'll be one little different. So remember that the sale had two journal entries, right? One to record the sale and one to record the merchandise. And so I will have to do the same thing. So if they returned it, if I use that same one, instead of, when they purchased it, I debited accounts receivable and credited sales. So I need to flip-flop those, but instead of debiting sales revenue, I'm going to debit an account called sales returns and allowances, and then I'll credit their accounts receivable. So again, let's say they returned that whole thing, and so I credit accounts receivable to take that whole thing off their balance, and I debit this account called sales returns and allowances. It's kind of like a contra sale account. But then I need to undo the rest of the transaction. So before, I debited cost of goods sold and I credited merchandise inventory, so I will do the opposite. I will debit merchandise inventory. The customer sent it back, so I have it again. So I need to add that to my asset, and again, to me, the value of that was worth $700. So I put it back into merchandise inventory for that $700, and then I credit cost of goods sold $700. So it's really it's exact opposite of the sale. Again, this is what the customer paid for it, and this is what it cost me originally, except I just have the sales returns and allowances account. And then again, I have to worry about the transportation costs. So if it's FOB shipping point, that means, and again, I'm the seller this time, right? So FOB destination means the seller owns it during shipping, and the seller is responsible for shipping costs, pays shipping costs. And now, if I'm on the sales side, that's me. So I have to pay that shipping cost. So we'll see that as like a freight out. Now, when I was the buyer and I had to pay shipping costs, I just added it to merchandise inventory. But as the seller, I don't want to just add that to revenue, because that is not revenue for me. Even if I charge the customer for it and I lump it on the bill, the fact is I still have to pay the shipping company for it. So that's not revenue for me, and I don't ever want to count that as revenue for me. So for me, that freight out, that cost for me to deliver it to my customer, is an expense for me. So I debit an account called delivery expense, and then I probably credit cash because I paid for it. So on the buyer side, if I pay for shipping, I just lump it in with merchandise inventory. But on the seller, if I'm paying for shipping, I put that into a delivery expense account. So, okay, so the net sales revenue. So I take my sales revenue, and this again is very similar to the net purchases. So sales revenue minus sales returns and allowances, the stuff that they sent back, minus sales discounts, will give me my net sales revenue. So that's the bottom line number that I earned in sales, minus cost of goods sold, gives me gross profit. And we will see these things all on the income statement. So we'll see the sales revenue minus the returns and allowances minus the discounts for net sales revenue. And then we'll see that gross profit on the income statement as well. So let's do a demo problem here where we're looking at sales transactions. So in this one, we sold $66,000 worth of sportswear on account. Credit terms 210, net 30, and the cost of that merchandise to me was 33. So that means I paid 33 for it, and now I'm turning around and I'm selling it for 66 to somebody else. So the difference there is my markup or my gross profit. So on August 1st, I will debit accounts receivable and credit sales revenue for $66,000. That's what I sold it to the customer for. So that's the first journal entry. And then the second journal entry is a debit to cost of goods sold, a credit to merchandise inventory for what it cost me. That's the 33. So both of those journal entries are necessary to record that sale on August 1st. Then on August 5th, the customer returned part of that. So again, I need to flip-flop these, except instead of sales revenue, I debit sales, returns, and allowances, and I credit accounts receivable to take that off of their bill. They don't owe that to me anymore because they returned it. The cost to them of what they returned $5,000 worth of stuff, but that's what they paid for it. The value of that to me was $2,500. So then I undo the second transaction. So I debit merchandise inventory because they sent it back to me, and I credit cost of goods sold to undo that expense for what it cost me, the $2,500. So you can see here they pretty much have 100% markup. They double the price there, and so we've got the same relationship here. And then on the 10th, they pay me. So I know I'm going to debit cash, and I know I'm going to credit accounts receivable. So let's see, they owed me $66,000 originally. That's here. Then they returned $5,000 of it. So the total amount that they owe me right now is $61,000. But they're going to take a discount, right? They're going to take a 2% discount. So 2% of $61,000, what they still have, is 1,220. So that means what they're going to pay me is $59,780. So that's what they're going to pay me in cash. So the accounts receivable says they owe 61, but the cash I'm going to receive is the $59,780. But I need to debit accounts receivable for the whole $61,000. So the difference between the two goes to that account sales discounts, and that's for the 1,220. So that's what a sale looks like, a return looks like, and that's what getting paid looks like. So I want to do one more problem on this one. I really like this problem. So Muddy River sells 2,000 books on account for $19 each to this store called Salem. The cost of that books to Muddy River was $22.08, and they sold it on terms $120, net $45. So they'll get a 1% discount if they pay within 20 days. Otherwise, the balance is due in 45 days. Then on the 13th, they returned 100 of those books, and then on the 22nd, Salem paid their bill. So what we're going to do is we're going to look at these three transactions from both the seller side and the buyer side. So the Salem store is the buyer, so those will be the purchase transactions, and Muddy River is the seller, so those will be the sales transactions. So we'll look at Salem over here, the buyer, and then we'll have Muddy River over here, they're the seller. So the first transaction on 10/10 is just when they purchase the merchandise. So for them, they don't know what Muddy River paid for these, right? That cost, that's irrelevant to the buyer. The buyer just knows what they paid for it. And they bought 2,000 books at $19 each. So they're being charged a total of $38,000, and that's the only number that's relevant to them. So they will debit merchandise inventory for $38,000 because that's what they bought, and they'll credit accounts payable because that's what they owe. On the seller side, let's go ahead and do that while we're over here. On the seller side, they will debit their accounts receivable because that's what they have coming to them for $38,000, and they will credit sales revenue for $38,000. But then they need to record what went out, so they'll debit cost of goods sold and credit merchandise inventory. This is what went out, but they'll do that for what it cost them. That's the 22.8. 22.8. So there's the first transaction. The second transaction is they returned 100 of these books. So 100 books times $19 each, that's $1,900. So on 10/13, they will debit their accounts payable to reduce the amount that they owe by $1,900, and they will credit merchandise inventory. So again, it's the flip-flop of the purchase for $1,900 because they don't have that stuff anymore. Now when Muddy River gets that, again, they'll undo the sale, right? So they will debit sales, returns, and allowances and credit the accounts receivable to show that they don't owe that anymore for the $1,900, and then they have to undo this transaction, or at least part of it. So they will debit merchandise inventory to show that they have that back in, and credit cost of goods sold, since the sale, that part of the sale didn't happen, they want to undo that, and they're saying the cost of what was returned was $1,140. So that's how the return looks like to the buyer and how that same return looks to the seller. And then on October 22nd, Salem pays Muddy River. So for Salem, they're paying their accounts payable. For Muddy River, they're receiving on their accounts receivable. So they bought $38,000 worth of stuff, and then they returned $1,900 worth of stuff. So the amount that's sitting on their accounts payable, the amount that they owe is $36,100. I think I put an extra zero there. $36,100. And then they're going to take that 1% discount. Remember, the terms here are $120 net $45. So if they take a 1% discount, that means they're getting a $361 discount. So the amount that they're actually going to pay in cash is $35,739. So for the buyer here, for Salem, they are going to debit their accounts payable. The amount that they're they need to debit accounts payable for the whole $36,100 that they owe. But the cash that they're going to pay, so they're paying, so it's a credit to cash, is going to be the $35,739, and the difference, that $361 discount, remember, for them is a credit to merchandise inventory. So now their merchandise inventory will be the 38 minus the 19 minus the 361, so that'll be showing as the 35,739 as their total cost of inventory. That's their total net purchase. From the seller side, they're receiving cash, right? How much cash did they receive? They received $35,739. They will have to debit sales discounts for the 361, and then they will credit accounts receivable for the whole balance, which is the $36,100. And so you can see here that the cash that Salem paid is the same as the cash that Muddy River received, and the net cost of the purchase should equal the net sale over here on the other side. So that's a sale, a return, and a payment as it looks on the buyer side and as it looks on the seller side. So that are the sales transactions, and that's mostly what you're going to see. And I will pick that back up then with the rest of the chapter.